So we'll move on now in terms of our next speakers for this morning. We're moving on to another two speakers from industry. I'll now have to figure out which of the two microphones I use. Two speakers from industry. So we're lucky to have here Jenna Cooke and Louise Miller from Suncorp, who will be taking us through the terminology changes that we need to get our heads around when we're now transforming from the old standard to the new standard, because speaking the new language will be key. So maybe if I ask you two to come up now, and you can take us through it. Thank you very much.
Well, thanks, Jeff, and good morning, everybody. My name's Louise Miller, and I'm joined by Jenna Cooke. As you've heard, we both work for Suncorp, and we've been on Suncorp's IFRS implementation program for about getting close on 12 months now. So Jenna has an actuarial background, and I have an accountant background. So hopefully today we'll bring you a little bit of a perspective from each of us. We're going to start from what Rianne has gone through with us this morning, and we'll expand on those concepts a little bit more. Maybe for some of you in the room, I'm looking around, I've met before, you perhaps even know more than I do, but I'm sure you do actually. But for some of you who might be early on your journey to IFRS 17 implementation, hopefully we'll give you a bit more detail from what Rianne's gone through, and then that will be built on throughout the other topics today. At the end, what we're aiming to do for you is to pull together a high-level overview of what some of these new terminology and concepts under IFRS 17 mean compared to our current accounting standards in Australia based on IFRS 4. As maybe just point out as well, we have a general insurance background. So we're trying in our presentation to give you a flavour for items that also impact life and health, but I'm certainly not an expert in those areas. One thing I noted before too, for those of you that are fairly new on your journey, as you read through a number of the publications, there's always different ways, pictorials to display some of these concepts. So I've found it's been quite good to have a look at a number of different publications and find the thing that helps you understand the concepts best. So just some brief recap. So Rianne went through, the first thing we need to do is understand what contracts are within the scope of this standard. So we've mentioned that the standard's around insurance contracts, not insurance entities, and it's common to all types of insurance contracts. We've touched on the definition of an insurance contract, which is on the slides that you will get. It is very similar to what we've got in IFRS 4, but there are a few nuances. Similar to IFRS 4, there are some scope exclusions. Some of those have been carried forward from IFRS 4, but there is some new scope exclusions, and there's a few on the screen there we've noted related to credit card contracts and certain loan contracts, which are still pending the final deliberations of the IASB under the current exposure draft. I won't go through this slide in too much detail because I think Rianne touched on that a little bit before, but it is important to note that once we know what contracts are covered, you do need to separate out the distinct components and account for those under their appropriate accounting standards. And the idea here is by separating out those distinct components, users of financial statements should be able to see like on like for similar contracts. So we mentioned that we have embedded derivatives. Some of you will be quite familiar with that concept already. And IFRS 9 sets out the criteria for when you need to separate an embedded derivative from your host contract, which for us will be insurance contracts. Investment components also need to be separated from your insurance contract if they are distinct. So a distinct investment component is where that investment component is not highly related to the insurance coverage that's provided under the contract. And also, if there is another entity or the insurer that offers a contract that has the equivalent terms or could have the equivalent terms in the marketplace. So they also get pulled out and accounted for under IFRS 9. Distinct goods and services. So a number of our insurance contracts may also include other services. An example of that may be where an insurer provides claims processing services along with insurance coverage. So those type of components do need to be pulled out and accounted for under the revenue standard IFRS 15. One thing to note, if you're reading some of the basis of conclusions or some of the discussions as part of the transition resource group material, the IASB did consider whether it could make that wider and allow entities to separate out whatever they like, particularly if it was non-distinct components. But that's been considered, and from the IASB's perspective, allowing entities to separate out non-distinct components, it would be difficult to do that in a non-arbitrary way. So therefore that is, as a general rule, not permitted under the standards. So we need to stick with these particular types of components. So now we've got the group of contracts that are covered and we've separated out any distinct components. The next key principle to work through is measurement and how we aggregate contracts. So IFRS 17 allows insurers to aggregate or group contracts for the purposes of measurement, and it also does then impact some of your disclosures. And this is referred to in the standard as level of aggregation, which Rhiannon did touch on. So the first step here is you need to assign each of your individual contracts into a portfolio. So what is a portfolio? It's contracts that have similar risks that are managed together. Some of you, I think, might be saying, well, that's pretty similar to what we have now as a definition in IFRS 4, particularly as it applies to the liability adequacy test. So it is the same, and similar to today, it will be up to each entity to work through from their own judgment and their own business models what are similar risks and how are they managed together. But Rhiannon touched on, I think it's fair to say from what we're seeing from practice in the industry, that it's highly likely that the portfolios that each entity decides on will be at a lower level than we do the LAT test today. So once you have a portfolio, you then need to subdivide that portfolio into groups, and that grouping is based on profitability. So there's 3 potential groups that you may have. The first is a group of onerous contracts at initial recognition. Then secondly, you need to identify, do you have any contracts that have no significant possibility of becoming onerous at a subsequent point in time? So some business that you're quite confident with that will be profitable. And then we've got the remaining group, what's left in the middle, which is probably then what you think is unlikely to become onerous. That breaking into these 3 groups is made at inception, so on initial recognition, and you do not change that post that point in time. So even if you have a contract up front that you think will be onerous, that is onerous, and you put it into the onerous bucket, if at a later point during that contract period it becomes profitable, it still stays within that group. So then in addition to groups based on profitability, we then have cohorts. Rhiannon mentioned that. So the IASB will not allow you to have a group that has contracts within it that have a contract period greater than 1 year. You can choose to break that down into smaller groups if you like, but that 1 year is the maximum. So having a look at what the IASB was trying to do when we look at breaking contracts down based on their profitability, as well as then putting them into annual cohorts, what they're trying to do there is ensure that useful information is provided to users of financial statements about profitability of insurance contracts. So they're trying to ensure that we are not offsetting loss-making or less profitable groups of contracts against those that are quite profitable, and they're also looking to be able to see the trends in profitability over time. So you don't have contracts issued in a particular year that are multi-year and quite profitable, perhaps offsetting losses made in additional contracts that we take on in future years. From a practical perspective, as entities, you might want to break that down further, any of those down further to assist you with your valuation processes, perhaps provide more granular information for your management reporting and potentially even APRA or other regulatory reporting, but that's optional. I think it's fair to say from our perspective, and I think from a number of you out there in the industry, this is quite a key concept. And wherever you land, this level of granularity can have a significant impact on how you need to set up your systems, your data, the processes you have. So it does pay to take a bit of time and think through and try and get this right up front. Oops. So just by way of introduction, Rian mentioned there's three models here, the general model being the default model or the primary model to use under the standard. Sometimes also is referred to the building blocks method because it can be in a picture shown as a number of building blocks around different your cash flows, the adjustments you need to make to those cash flows, and then determining what your contractual service margin, your expected profit or your loss component will be. That's the default model. There are certain criteria, and if an entity meets those criteria, they can choose to use the premium allocation approach. And then, I suppose more applicable to the life insurance industry, if you have contracts with direct participation features, you then use the variable fee approach. So you really need to look at your own contracts and the nature of those contracts, and then determine which model you need to use. We'll touch on it a little bit more detail, but certainly the PAA methodology requires some less information. It is a little bit easier. It's a bit more intuitive to what us general insurers know and understand today. So where possible, some insurers will be taking, trying to make the eligibility test meet and then use that as their options going forward. So now I hand over to Jenna and she'll take you through those models in a little bit more detail.
All right, so I've got the actuarial part of this where I'm basically going to take you through some of the different measurement models. There's a lot more detail that sits underneath this, but I thought just to be able to give you a bit of an overview of some of the main components and how we work through them. So as Louise mentioned, the general model is your default option. So I thought I'd go through that one first, just to give everyone a bit of a grounding. It's not too dissimilar to margin on services, as I think a few people have mentioned today. There are some significant differences when you get into the detail, but conceptually it has the same sort of thinking behind it. So the core components of the general model are future cash flows, which includes your premiums, claims, benefits, expenses, your discount rate, which is used to generate the present value of these future cash flows, and then also a risk adjustment, which is applied to account for the uncertainty around the amount and the timing of those future cash flows. So as I think Rian mentioned earlier, there is a liability for remaining coverage and a liability for incurred claims. In essence, the LRC is really quite similar to the premium liabilities that we would do today. So really about the unearned portion, and the LIC is around more like your outstanding claims valuation, so the earned portion. So all of those three core components relate to both parts of the equation, but then you've got this extra present within LRC of the CSM. And what that does is it's effectively a profit deferral mechanism, so conceptually not dissimilar to MOS. And I'll go through that in a little bit more detail. So what I'm going to do over the next few slides is break down each of those core components and explain a little bit about what's in them. So looking at future cash flows, basically what we need to make sure of is that the future cash flows need to be within the boundary of the contract. It's got a bit more of a strict definition than we see today. It's got to relate directly to the fulfilment of the contract. So you'll hear a lot about directly attributable as you go through the days, and that's kind of what it's coming at. It's got to be something that was used to fulfil the services of the insurance contract. And it has to include the cash flows over which the entity has discretion. So the fulfilment cash flows are described as the probability weighted mean of a full range of possible outcomes, which is a little bit cumbersome. and theoretically shouldn't be too dissimilar than what we do today, but obviously is a slightly different definition. I'll go through that a little bit later. So the inflows pretty much just include your premiums, largely, and your outflows can be claims and benefits, acquisition costs, CHI, PAE, claims recoveries, and any overheads that are directly attributable to the selling and the fulfilment of that insurance contract. What's not included are reinsurance recoveries. They are no longer netted off as part of your cash flows. They are measured in their own right. I'll go into that a little bit later. So the next concept isn't too different to what we do today. So time value of money, we need to make sure that the cash flows are in present value, and that's where the discount rate comes in. So what's interesting is that there are many global jurisdictions where this is not necessarily a given. So you'll hear different global audiences who are a little bit concerned about this part, but for us it's not too different. The standard gives you two different approaches to determining the discount rate. So the top-down approach or the bottom-up approach. You'll hear top-down and bottom-up a lot when you listen to this standard, given the whole aggregation and granularity elements of it. So I think for the Australian and New Zealand markets, really that bottom-up approach is something that we're all a bit more familiar with. So we use the risk-free approach today, and as Rian mentioned earlier, it requires an addition of a liquidity premium. What's interesting is that in APRA's indicative direction letter, they've actually come out and said that for their capital framework, they are still considering making insurers use the risk-free rate only. So this is a potential issue, if we can't overcome it, that will potentially cause some operational challenges as we go through. So the Institute of Actuaries of Australia actually has a task force at the moment, and they're working through issues such as this. So risk adjustment is the third core component of the calculation. It's not too dissimilar to the concept of risk margin for general insurers, but obviously it's a completely new concept for our life insurers. And this risk adjustment needs to be applied to the present value of future cash flows. What's a little bit different is that it needs to be applied to your direct future cash flows and also your reinsurance present value of future cash flows. So in the current environment, we net off all of the reinsurance before applying a risk margin in general insurance. Going forward, you have to keep your two cash flows separate. So the underlying gross contract, you need to do all of these calculations for, and then the reinsurance cash flows as well, you need to do these calculations for. So for anybody who's a little bit more distribution-minded, or I love to be, I don't know who else is, but basically when you think about a distribution, if you're doing something to a net versus doing something to the gross and the underlying components of that, it can actually create some challenges. So, for example, when you're trying to come up with a risk adjustment for your gross underlying contracts, if there is no available reinsurance, that becomes almost an endless whirlwind of possibilities. So there is a lot of effort going into that at the moment. So there is a reinsurance task force, a reinsurance working group, which is connected into the Institute of Actuaries task force, who are looking into such practical questions of how do you actually derive a risk adjustment, how do you do it for your underlying contracts versus your reinsurance contracts. And the ultimate goal there is to try and come up with something, at least from a general insurance principle, which almost arrives back at a similar result to what we do for today. The other key difference is that there is a slight definitional change, which I think Rian went through. But effectively, one of the core differences is that really the risk adjustment doesn't include financial risk, whereas the risk margin does. So again, we need to practically work through what that means when you go to calculate the results. The size of the risk adjustment should be very similar to what drives the size of the risk margin. So effectively, I've got a few of them up on the screen, but it really comes down to how certain are you around the estimates. If it's something that is infrequent and large in your claims profile, it's likely going to have a little bit more uncertainty and have a high risk adjustment, for example. So it'll be interesting to see what the Institute Task Force comes up with. And they're working very closely with APRA to try and see how we can align the logic framework of risk margin back into the risk adjustment calculation. All right, so now to the CSM. So you'll see we've got a little diagram on the left, and you'll see that the CSM is only part of the LRC calculation. And what it does is it's established on initial recognition to offset initial risk-adjusted profits. And at this point in time, a discount rate is also locked in, and that discount rate is used for the duration of the contract. So as you go to do your calculations going forward on subsequent recognition, you use the same discount rate for that cohort that was locked in at that time. When you go through to subsequent recognition in the CSM, what you'll do is, we know that we need to account for things in cohorts. So you've got a 12-month period of claims coming in for this group. You add in any new claims that relate to any new sales of policies that relate to that 12 months. Once the 12 months is over, you close down that part of the calculation. You accrete interest based on that locked-in rate that you determined on initial recognition. And then you also adjust for changes to the fulfilment cash flows related to the future service, which again is measured at locked-in discount rates. And that then establishes the new CSM. The difference between the two can then be recognised, hopefully, as profit in your insurance services result. And that cycle continues until the entire cohort is run off. So I think Louise mentioned earlier, a lot of general insurers are looking for ways to basically get out of this model. And I think when you consider potential cohorts for each product running off and continuing this calculation in different ways over time with locked-in discount rates at a point in time, you can start to think about the complexities of both data management, calculation management, and making sure that you've got something that is auditable and traceable at the end. So there's a lot of work that goes into making sure that this calculation works. So I think Louise was going to take us through how do we find out if we're eligible to use a PAA model.
Thanks, Jenna. Yes, so eligibility for PAA, given quite a lot of insurers will be looking to use that model wherever possible. So the first criteria is, do you have a contract or a group of contracts that has a contract period of 1 year or less? If so, it's like a tick and you're eligible. If your contract has a longer period than 1 year, you're entitled to do a test where initially you estimate what your liability for remaining coverage would be using the PAA, and you also measure what that would be under the general model, and if the difference between those two outcomes is not materially different, then you can still use the PAA. So it's probably, I think, in a little bit of a later session today, perhaps PAA eligibility testing is gone through in a little bit more detail, but there's the mechanics of that, if we call it the second step, if your contract is greater than 1 year. So there's the calculations of those two outcomes under the different models, but it's also, as I suppose combined actuaries and accountants, you need to think through, is that material? How are you going to make that assessment? So once you've done that, you've established that you're eligible to use the PAA methodology. It's been touched on a little bit this morning, but very similar to what we're used to in general insurance in Australia, and as I understand, that would be fairly consistent for some health insurers as well. You're entitled to use this methodology for both your direct contracts as well as reinsurance contracts. On the slide there we've set out, once again, PAA has a liability for remaining coverage as well as a liability for incurred claims. Your liability for incurred claims is essentially the same as under the general model, although if your contracts have a period of less than 12 months, you can choose not to discount that liability if you wish so. Looking at the liability for remaining coverage, very similar to what we have now as unearned premiums, less your DAC. Rhianne pointed out, but the standard is around cash flows. So it is around premiums received. So if we're thinking of some of our current terminology, probably also need to think about your premium debtors, your premium receivables, because we are looking for premium received. Acquisition costs. Under the PAA, once again, contracts with a period of less than 12 months, you can choose to expense your acquisition costs immediately. So we're all, I think, quite familiar with DACing and having a separate DAC asset on the balance sheet. You can choose now to expense those costs immediately. There is a few things under consideration with the IASB in the current exposure draft, and in certain cases you may end up with what I call a explicit DAC asset on your balance sheet. But as a general rule under PAA, if you're choosing to defer those acquisition costs, it's essentially like a negative liability. It's coming in as part of your liability for remaining coverage. We don't specifically calculate a contractual service margin on day one under this method. We look to earn your premium over the contract period, and usually we would expect that to be very similar to what we do today. But similar, under the general model, there is no recognition of profit on day one. Also, under the premium allocation approach, we are considering losses. So if there is a loss component for a cohort of contracts that is being measured under PAA, you do end up with that loss component to form part of your LRC. If you meet the criteria and choose to use the premium allocation approach, as regarding to onerous losses, the standard does, I suppose, consider up front that the base rule is that a group of contracts measured under PAA are not onerous unless you have facts and circumstances that indicate that cohort would be onerous. So you don't actually need to do a calculation and determine have you got a loss or are you expecting a profit. So you just need to use your existing management information or other sources that you have to determine have you got facts and circumstances. And if they don't exist, you can assume that that group of cohort of contracts is expected to be profitable throughout its life. So the final measurement model is the variable fee approach, or VFA, applicable to life insurers where they have contracts with direct participation features. So in summary, that's a contract for which there's an investment component to that, and that both the insurer and the policyholder have a share of returns based on an underlying group of items, often some kind of investment assets. So the VFA is a modification to the general model or the building blocks approach. It has a liability for remaining coverage and a liability for incurred claims, calculated the same way. The key, or the only difference here really, is regarding the contractual service margin and how you measure that subsequently. So Jenna mentioned you calculate your contractual service margin up front, and then you need to recalculate that at each of your balance dates, and the difference is your profit that you recognise. So under the VFA, in the subsequent measurement, what that effectively allows insurers to do is it can reflect the economic movements, so market movements in that underlying group of items or assets for which an investment return is generated. Those movements can be reflected in that CSM, so they don't need to go to profit immediately. So what that does is potentially help where you've got significant variations in market movements in certain periods, that's not reflected immediately in your profit. It's sort of spread over the period of the contract. The other point to note is that you are unable to use this measurement model for reinsurance contracts. Which is a nice segue into reinsurance.
That's actually well done. So reinsurance. So I mentioned a few times that reinsurance is quite different under this new standard, and I think it's one of the bigger changes to this standard from what we do today. So rather than being netted off, as we do today, under IFRS 17, reinsurance is accounted for separately from the underlying contract to which it relates. So this means that reinsurance contracts will need to be measured under one of those measurement models, either general model or PAA, that we just took you through, distinct from the underlying contracts, which will also go through that same measurement process. So it's quite easy to see how complicated that could get. It requires you to continue to link the underlying contract to the reinsurance contract throughout. And there's a high potential for accounting mismatches to arise. So a simple example of this might be a multi-year reinsurance contract, which could get measured under your general model approach, relating to, for example, an underlying book of motor insurance policies, which would be measured under your premium allocation approach method. So that could potentially mean that you're not necessarily netting off the reinsurance in the same way that you do today. So visually, and also in terms of the emergence of profit on the P&L, that could create some timing mismatches within the reinsurance area. So this is one that has generated a lot of debate globally, as you can imagine. It's one of the hardest parts, like both to operationalise, to interpret, and to understand how you're going to apply it. And realistically, I think that we've still got a way to go on that. So coming out of the exposure draft, there was still a lot of commentary around the treatment of reinsurance through the standard. And it seems to be a bit of a global trend that reinsurance is moving a little bit. So even when you look at some of the larger players and where they're at in their implementations, they all seem to be really starting with direct and then turning to how do we do this for reinsurance. But I would caution if you do that, particularly, I suppose, when you look at what we've had to account for reinsurance in the past, we've been able to utilise pretty small amounts of information to be able to generate our statements. Going forward, you're effectively replicating everything you do for direct for reinsurance, which is going to require a huge amount more information on reinsurance to be available. So that's just something to think about as you start your own implementations and work through that. Okay. So here we've basically attempted to try and summarise some of the key concepts of IFRS 17 and compare them to the existing IFRS 4 standards which apply across life and general insurance. So the concepts are listed down the left. The blue column is IFRS 17. The purple is 1038 or life, IFRS 4. And the green column is the GI equivalent. So Louise, I think, is going to take us through. Yeah, tag team.
So we've got some of the key concepts here that we and Rianne have gone through today. So we've just finished on reinsurance. So the key difference here is the standard requires you to separately value your direct and reinsurance contracts, and there's some separate disclosures around those. And as we've just discussed, today we're used to having a net position for those. The next item is contract boundary. So what's sort of like the bookends of your contract period? That's fundamental to determining what are your cash flows that you include in your valuation model. So for a lot of contracts, the net result of that under IFRS 17 is probably similar to what we do today, but there's certainly some notable exceptions. So say in the life insurance, we'd have an example of the yearly renewable contracts, which now potentially have a shorter contract boundary than we're used to at the moment, and maybe something like consumer credit policies in the general insurance world. So there are some differences there.
So in terms of the valuation approach, so as we've discussed, the general model is not too dissimilar conceptually from margin on service, but when you get into the detail of the outworkings, does have some differences. And from a general insurance perspective, the PAA model is not too dissimilar to what's done under the current standard. The fulfilment cash flows, while they almost sound the same, there is some slight difference. So under IFRS 17, it is the probability weighted mean of all possible outcomes. For life, we've always had your BEL, your best estimate liability, and for general insurance, you've always had your central estimate. So we just need to sort of figure out what differences, if any, that slight change in interpretation brings about.
So from an expense perspective, IFRS 17 introduces the concept of expenses that are directly attributable to the fulfilment of a contract, and you need to be able to associate that at least at that portfolio level. So an area where that level of aggregation decision does become important. So I think in a summary way, what that means is you need to look at your expense base and determine what is directly attributable to servicing and fulfilling the obligations under your insurance contract. So for a general insurer today, I'll say maybe a large proportion or almost all of your expenses go into either being your acquisition your acquisition costs, your claims handling costs, or your admin or your maintenance type costs. So what would we expect to see here is that there will be a level of costs within an organisation that are not directly attributable to a portfolio. So therefore there's probably less expenses of a total expense of an entity that falls within your insurance services result. But it'll still be in your P&L, they're still your expenses, but it's where they end up either in your calculation of liabilities and where that flows through into your P&L. Also from a deferral perspective, we expect some of those rules to be different. One of the things that's being debated as part of the current exposure draft is that where you incur acquisition costs that you as an insurer believe relates to the current business, your current cohort, but also future business, a future cohort, can you actually defer some of that on your balance sheet and then put that through your profit as those cohorts, those future cohorts actually come on your balance sheet and you create a liability. But depending on where that lands, that might be significantly or a little bit different for what life insurers are used to today.
So discount rate, as we've discussed, really the difference is today it's largely risk-free, apart from my understanding is some life insurers do use a liquidity premium for longer dated durations. But effectively that's the change there. And risk adjustment we've talked through quite a bit, but to summarise, it's that difference of net versus direct and reinsurance, and also the exclusion of financial risk for general insurers from the risk adjustment.
So we've touched on onerous contracts or your loss component. We certainly have that today, but as we've pointed out, under IFRS 17, we'd expect that to be calculated at a lower level of granularity. And there also is some differences in the disclosures under IFRS 17. There's some more information there as compared to what we may be used to disclosing if you have a liability adequacy deficiency under the current two standards. Oh, the last one's me, isn't it? And unit of account. So I suppose the default under IFRS 17 is that the legal form of your contract, that's the lowest level of measurement. That's the lowest level you consider the standard. It's fairly similar to what we might be looking at under our versions of IFRS 4 here in Australia, but there will be some differences that each entity will need to work through.
So this is our final slide. Basically what we're trying to do here is have a look at some of the differences that users of financial statements are going to encounter when they're looking at IFRS 17. So I think, as Ryan pointed out earlier, it's important to remember this is still an accounting standard, and accounting standards don't change the underlying economics of the business, just the way that it emerges over time. But what we will see is that the P&L and the balance sheet will change quite a bit in terms of their presentation, the information available, and the way that different items are pulled out. So effectively, your headline result is going to become insurance service result, and that's across all industries. As distinct from your profit before tax in life and your insurance trading result in GI. We've mentioned over and over, direct and reinsurance completely separate, and therefore on your P&L and your balance sheet, you effectively have all of your items for direct and reinsurance duplicated, no netting off. Adversely, actually, what we see in the P&L and the balance sheet is more of a netting off of different insurance items against each other than we see today. But what that means is that effectively a lot of the fun part goes into the disclosures.
So yes, definitely there's some new and additional disclosures. Probably one of them that in fact one of our colleagues gets highly excited about is what's known as the roll forward note. So where you reconcile from your opening insurance assets and insurance liabilities through to the closing position, looking at your cash flows and your P&L impacts. And also as part of that, you do separate out your business that's onerous versus your business that's not. And as we've discussed, you do that for reinsurance as well. There also is some expansion of the information needed in some other notes that we do have today. And finally, just the other consideration, we've touched on APRA and other regulators. So we're talking about the accounting standard, how we do valuations, how we present that internally and externally, our statistical returns for APRA, our capital calculations, sometimes even how we do your taxable income with the ATO, base themselves off accounting standards, and then they have certain adjustments to meet the particular outcomes of those regulators. So since we're changing that accounting standard, then I suppose if the regulators aren't changing that basis in their requirements, then we could end up with some differences. And I know we have a session later today with APRA, but there could be other regulators for those of you that have got businesses in many jurisdictions, that we just need to work through that, and ideally in a collaborative approach with our regulators to try to ensure that where we've got not everything's the same, but a large degree of consistency, that we can hopefully continue that through once we implement IFRS 17.
So yes, just as a bit of a closing thought, Louise and I have been working pretty closely on this for about a year now, and there's a lot of jargon in the standard. There's a lot of new terms for things that aren't too dissimilar to what we do today. So hopefully we've given you a bit of a snapshot of that. As you work through it over the next 2 days, you'll hopefully come to appreciate what it's taken us about a year to figure out, is that the devil is truly in the detail. As you go to try and operationalise, interpret and apply this standard, that's where it gets really interesting and really fun. So hopefully we've been able to give you a bit of an overview, and as an industry, it's important to remember nobody's actually implemented IFRS 17 yet. We're all still trying to figure it out, so I definitely encourage all of you to try and participate in as many forums as you can, because the more consistency we can get as an industry, and particularly as a local industry, the better it's going to be for ourselves, our auditors, the users of our financial statements as well. So thank you very much.
So don't run away yet. I've been moderating, I don't know, it feels like there's about 100 different questions. So there's obviously a lot of energy in the room about this, so it was quite hotly contested. Look, to try to keep us at time, we can't go through all, and I've tried to group some and select some out, some of which you've already covered, but nice to have them up. So if we could put the Slido questions up, we'll try to look at a few of them, and I can help also with just sort of reading it through, one or two, just while we get the it working here. And for those that don't make the cut, we're able to keep an archive, so we'll keep a bit of a back catalogue that at the end, then if there's some sort of FAQs we might have. So the first one was around challenges of determining contract boundaries, and particularly any examples. I know you've covered a little bit of that, but is there anything extra that you wanted to share with the room around some challenges that you faced in the detail?
Yeah, so I think we found, we have a small life business in New Zealand. We found that they've particularly had quite a few challenges around this. I think for general insurance, it's potentially not quite as challenging. So they're finding that as you work through some of the life challenges, they'll have different components built within different contracts, and that's what they're struggling with quite a bit. So apologies, I can't talk too much about it. Not being from a life background, it seems to be a pretty hotly contested challenge for them. Louise, did you? That's pretty much.
I think the only other thing too, particularly with our colleagues for life in New Zealand, is really thinking through what are the elements of a contract, and are they separated or not as well, and then thinking about contract boundaries, because as I'm not a life insurance expert, but often if contracts are combining a number of different types of risks or covers, then each of those covers may have quite a different contract boundary. So working through, is that, as we talked about, the default legal form of the contract, or do they need to be separated, also comes into then what's your contract boundary?
Yeah, so I think it's just not, RPGs are just sort of having to be reevaluated, because an RPG is not necessarily aligned when you look at the wording of the standards. So there's a lot of work to go around and figure out exactly how that builds up.
Then there's a whole grouping of questions around onerous contracts or definite onerous testing. How often to do it? Is it every year? At what level do you need to do it at? Differences between likely onerous and unlikely to be onerous. Any insights that you can share?
Right, so there's a lot. I mean, we could talk
You
about
only have 2
contracts
minutes.
for 2 days, but for 2 minutes, basically, as we said, you have to determine. So it's different for general model versus PAA, another one of the key requirements. If you think about the general model, you're doing things in a lot of detail. You have a lot of information. You will know what parts of your cohorts are onerous and which parts aren't. You, as Louise mentioned, you determine upfront what is onerous and what's not for that particular year of cohort. Once you've tagged it, that tag sticks for life. It's like the scarlet letter. You can't get rid of it. So you do it when you first write the book of policies. You put that flag on it. And then you basically track it as onerous through life, regardless of the outcome. Same vice versa. If you think something's going to be profitable when you write it, you've flagged it as such. If it turns unprofitable, it's not onerous. It's what you do at the time. So the testing happens upfront per cohort. The difference with PAA is that you don't necessarily perform all these calculations at that granular level, and the standard actually says that if facts and circumstances indicate that something is likely to be onerous, then you should flag it up front. So it's up to all of us to determine what are facts and circumstances. When you read the standard, it's quite helpful like that. It's very principles-based. So from a PAA perspective, it's a little bit more tricky to try and figure out, but I think from a general model perspective, you'll know when you go to do the calculations initially, you'll flag it. What's important to note is that even if the calculation assumes that you're going to be loss-making, it doesn't automatically put it into onerous. You can always have a discussion with your management team, with your auditor, to understand, are there particular circumstances that would make you think that over the life of that contract it will become profitable? So basically with onerous, it always gets the most questions. Everybody's very concerned about it. I think a lot of it's around to interpretation and working through your accounting policy around it. Does that answer? Any others?
That's good. And then maybe the last one, there's been a lot of questions around PAA versus GM and eligibility, and you covered a lot of that in your presentation already. But here there is a little bit about at what level would you be performing that at? And then also, if there's any insights, there are a lot of questions and some people wanting to be quite granular. So without divulging any corporate sensitive information, do you have any insights in terms of what you're seeing in terms of where your, operationally where your split might land?
So I think we can be fair to say, as we've described, the PAA methodology, you need less data, it is easier, it's more familiar as a general insurer to what our management is used to at this point in time. So we are looking at our eligibility testing at the moment, and I suppose our aim is, wherever possible, we would put both our direct and reinsurance business through PAA. So a lot of our business actually is shorter term, less than that 1 year. We do have some longer duration contracts, so then it's really getting into that, how different is that liability for remaining coverage under both those models. And I think from discussions with others that in the general insurance industry, there probably is a significant amount of business that can be put through that. But I think some of the considerations for some people is if you've got to put a lot of your business through general model, maybe it's easiest just to have one model and put it all that way. Maybe it's not.
Yep.
Certainly in our life insurance business in New Zealand, we'd be expecting it to have some PAA. So some life insurance contracts will fit that, but then there will be elements of general model and VFA as well.
Yes.
So I think it's just working, we've found, working through that, those contract boundaries, being clear on those and anything you need to separate out. Then if it's not short term, those calculations and how are you going to determine materiality. And I suppose from my perspective, trying to think about that now, but also setting up a framework that you can apply consistently into the future.
And the standard's pretty silent on this, so in terms of frequency of retesting, etc., there's nothing in the standard that says you must test it every year. So that's where I think, to Louise's point, setting up your own framework, getting that agreed with your auditor, and thinking about how you can operationalise that going forward is really important, because it's a bit choose your own adventure in that the standard doesn't specify these contracts must go here, these must go there. It's all down to looking at materiality, looking at how your contracts line up the best for you, and making sure that you get that agreed.
I don't know if it clarifies it, but maybe like if you've got a motor portfolio and some of that is onerous this year, you know, and you're doing PAA, you do need to, regardless of whether it's onerous or not, but when you come to your next cohort of motor policies, you still need to do that testing again. So you're doing it that
Every year.
once up front for your cohort, your group of contracts, but then as each cohort comes through, you do need to do that test for that cohort. You just can't assume that if motor was profitable when you first implement the standard, that it always is, and it's always short term, etc. There's no, well, motor should be, sorry, but there's no other factors that you need to consider.
But I think when we hear from the ISB members, they sort of say it's not designed, particularly for PAA, to be a witch hunt. It should be things that you know are unprofitable. You don't have to go looking and creating all new reports to go hunting down onerousness. It's what do you know is unprofitable. You know you're entering into it knowing you're going to make a loss each year. That's how it works.
Thank you. That's very helpful. Will you both be hanging around for the morning tea, or if you are, you might? Okay. Well, look, for all the other questions that didn't make the cut, just be ready. You might have a long line of people hunting you down. Thank you very much. We've got a small token of appreciation for you. Thank you.